Namaskar. Greetings to all of you on the last day of Navratri, and my best wishes for a very happy Dashera and Gandhi Jayanti tomorrow. Since the August policy meeting, significant developments on the domestic front amidst a fast changing global economic landscape have altered the narrative on growth inflation dynamics in India. Buoyed by a good monsoon, the Indian economy continues to exhibit strength by registering a higher growth in Q1. At the same time, there has been a considerable moderation in headline inflation. The rationalization of the GST is likely to have a sobering impact on inflation, while at the same time stimulating consumption and growth. Tariffs, on the other hand, will moderate exports. As for the global economy, it has been more resilient than anticipated, with robust growth in the US and China. The outlook, however, remains clouded amidst elevated policy uncertainty. Inflation has remained above respective targets in some advanced economies, posing fresh challenges for central banks as they navigate the shifting growth inflation dynamics. Financial markets have been volatile. The US dollar strengthened after the upward revision of US growth numbers for the second quarter. Treasury yields hardened recently as expectation of rate cuts. Equities have remained buoyant across several advanced and emerging economies. I now come to the decision of the Monetary Policy Committee. The Monetary Policy Committee met on the 29th and 30th of last month and today to deliberate and decide on the policy repo rate. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. I shall now briefly set out the rationale for these decisions. The MPC observed that the overall inflation outlook has turned even more benign in the last few months due to a sharp decline in food prices and the rationalization of GST rates. The average headline inflation for this year has been consequently revised lower from 3.7%, which was projected in June, 3.1% in August, to now 2.6%. Headline inflation for Q4 this year and Q1 next year too have been revised downwards and are broadly aligned with the target despite unfavorable base effects. Core inflation for the year and Q1 next year is also expected to remain contained. The MPC also noted that growth outlook remains resilient, supported by domestic drivers, despite weak demand. It is likely to get further support from a favorable monsoon, lower inflation, monetary easing, and the salubrious impact of the recent GST reforms. However, growth continues to be below our aspirations. Even though the growth projection for the current financial year is now being revised upwards, the forward-looking projections for Q3 and beyond are expected to be slightly lower than projected earlier. This is primarily due to trade-related headwinds, despite being partially offset by the impetus provided by the recent GST reforms. Summarizing, the MPC concluded that there has been a significant moderation in inflation. Moreover, the prevailing global uncertainties and tariff-related developments are likely to decelerate growth in H2 this year and beyond. The current macroeconomic conditions and the outlook has opened up policy space for further supporting growth. However, the MPC noted that the impact of the front-loaded monetary policy actions and the recent fiscal measures is still playing out. The trade-related uncertainties are also unfolding. The MPC therefore considered it prudent to wait for the impact of policy actions to play out and for greater clarity to emerge before charting the next course of action. Accordingly, the MPC unanimously voted to keep the policy repo rate unchanged at 5.5% and also decided to retain the stance at neutral. I will now be dwelling in some detail about our assessment of growth and inflation which has gone into these MPC decisions. First of all, growth. Economic activity has remained resilient, with growth of real GDP surprising on the upside at 7.8% and GVA at 7.6% for Q1 this year. As suggested by high-frequency indicators available so far, domestic economic activity continues to sustain momentum even in Q2. Looking ahead, an above normal monsoon, good progress of Kharif sowing, and adequate reservoir levels have further strengthened prospects of agriculture and rural demand. Buoyancy in services sector coupled with steady employment conditions are supportive of demand. This is expected to get a further boost from the rationalization of GST. Rising capacity utilization, conducive financial conditions, and improving domestic demand should continue to facilitate fixed investment. However, ongoing tariff and trade policy uncertainties will impact external demand. Prolonged geopolitical tensions and volatility in international financial markets caused by risk-off sentiments of investors pose downside risks to the growth outlook. The implementation of several growth-inducing structural reforms, many of which were announced by the Honorable PM on 15th August, including the streamlining of GST, are expected to offset some of the adverse effects of the external headwinds. Taking all these factors into account, real GDP growth for this year is now projected at 6.8%. This is a revision from our earlier forecast of 6.5%. Q2 now is projected at 7%, Q3 at 6.4%, Q4 at 6.2%. Real GDP growth for Q1 next year is projected at 6.4%. The risks are evenly balanced. I will now come to inflation. Inflation conditions remained benign during 25-26 so far, with actual outcomes turning out to be significantly lower than our projections. Low inflation is primarily attributed to a sharp fall in food inflation, aided by improved supply prospects and measures taken by the government to effectively manage the supply chain. core inflation remained largely contained, with the August reading at 4.2%. This is despite continued price pressures on precious metals like gold and silver. Turning to the inflation outlook, the progress of the southwest monsoon has been satisfactory. Healthy kharif sowing, adequate reservoir levels, and comfortable buffer stocks of food grains should keep food prices benign. The recently implemented GST rate rationalization would also lead to a reduction in prices of several items in the CPI basket. Overall, the inflation outcome is likely to be softer than what was projected in August, primarily on account of the GST rate cuts and benign food prices. Considering all these factors, CPI inflation for this year is now projected at 2.6%, with Q2 and Q3 at 1.8%, Q4 at 4%, and Q1 next year at 4.5%. The risks are evenly balanced. I will now dwell on India's external sector position. India's current account deficit moderated in Q1 this year to $2.4 billion or 0.2% of GDP. This is in comparison to $8.6 billion or 0.9% of GDP same period last year, on account of an increased net services surplus and strong remittance receipts despite higher merchandise trade deficit. During July and August 2025, for which we have data till now, merchandise trade deficit continued to remain elevated, notwithstanding rising global trade uncertainties. India's services exports, driven by software and business services, witnessed robust growth in the last 2 months, July and August. Furthermore, robust services exports coupled with strong remittance receipts is expected to keep the current account deficit sustainable during this year. On the external financing side, net FDI reached a 38-month high in July this year, driven by increased gross FDI and a moderation in repatriation and outward FDI. Net FPI, however, recorded outflows of $3.9 billion this year so far. We have data till September 29. This is on account of both equity and debt segment outflows. As on September 26 this year, India's foreign exchange reserves stood at a healthy $700.2 billion, sufficient to cover more than 11 months of our merchandise imports. Overall, India's external sector continues to be resilient, and we remain confident of meeting our external obligations comfortably. Notwithstanding the robust domestic macroeconomic fundamentals, the rupee has witnessed some depreciation accompanied by phases of volatility. We are keeping a close watch on the movements of the rupee and will take appropriate steps as warranted. I'll now be covering the liquidity and financial market conditions in the country. System liquidity, as measured by the net position under the LAF, stood at an average daily surplus of 2.1 lakh crore rupees since the last MPC meeting in August. Going ahead, the drawing down of government cash balance and the remaining 75 basis points cut in the CRR, which was announced earlier in the remaining period of October and November, will aid the banking system liquidity in the near term. Through our two-way operations, we will actively manage liquidity to anchor the short-term rates. Money market rates have been relatively stable amidst comfortable liquidity conditions. During this easing cycle from February till August, for which we have data till now, in response to this 100 basis points cut in the policy repo rate, the weighted average lending rate of scheduled commercial banks moderated by 58 basis points for fresh rupee loans. 71 basis points is on account of the interest rate effect. The moderation for outstanding rupee loans is to the extent of 55 basis points. Similarly, on the deposit side, the weighted average domestic term deposit rate on fresh deposits declined by 106 basis points against the 100 basis points cut, while that on the outstanding deposits softened by 22 basis points over the same period. Transmission of this monetary policy has been broad-based across sectors. Going forward, adequate liquidity in the system and the remaining CRR cuts will further facilitate monetary transmission. I now give my statement on financial stability in the country. The system-level financial parameters related to capital adequacy, liquidity, asset quality, and profitability of the scheduled commercial banks continue to remain healthy. Similarly, the system-level parameters of the NBFCs too are sound, with adequate capital and improved GNPA ratios. Bank credit growth, despite being lower than last year, continues to be healthy and supportive of real economic activity. I would like to emphasize here that as other sources of funding are gradually but steadily increasing their footprint, it is the overall flow of financial resources to the economy that is more pertinent for assessing flow of funds to the productive sectors of the economy. The total flow of resources from non-bank sources to the commercial sector increased by 2.66 lakh crore this year so far, more than offsetting the decline in the non-food bank credit of about 48,000 crore rupees. I shall now come to the additional measures. I have 22 additional measures aimed at, number one, strengthening the resilience and competitiveness of the banking sector. 2, improving the flow of credit. 3, promoting ease of doing business. 4, simplifying foreign exchange management. 5, enhancing consumer satisfaction. And lastly, internationalization of the Indian rupee. First of all, I have a few measures for strengthening the resilience and competitiveness of the Indian banks. The ECL framework, the expected credit line framework of provisioning with prudential floors, is proposed to be made applicable to all scheduled commercial banks and all India financial institutions. You would recall earlier a discussion paper in this regard was issued. We propose to make these effective from 1st April 2027, therefore giving sufficient time to the regulated entities. Moreover, there will be a glide path till 2031, so effectively 5 years. This is to smoothen the one-time impact of higher provisioning, if any, on the existing books of some of the banks. Furthermore, it is proposed to make the revised Basel III capital adequacy norms effective for commercial banks again from 2027. In furtherance of this, a draft for credit risk will be issued shortly. Under the revised approach, the proposed lower risk weights on certain segments are expected to reduce the overall capital requirements, particularly for MSMEs and residential real estate, including home loans. It may be recalled that capital requirement operational risk been finalized in 2023, whereas the capital requirements for market risk under Pillar 1 of the Basel III guidelines are under finalization after receipt of comments from the public. All these measures, we propose to make them effective from 1st April 2027. These measures will help align our guidelines with international standards adapted to our national conditions and priorities, and strengthen the capital adequacy framework for the banks and the all India financial institutions. 3. A draft circular on forms of business and prudential regulation for investment was issued in October last year. It has now been finalized after wide public consultations, and it will be issued shortly. The proposed regulatory restriction on overlap in the businesses undertaken by a bank and its group entities is from the final guidelines. The strategic allocation of business streams among various group entities of a bank will be left to the wisdom of the bank boards. It is further proposed, this is my fourth proposal in this, risk-based deposit insurance premium price irrespective of risk at 12 paisa per 100 rupees of net deposits. We propose to bring in risk-based insurance premium. This will incentivize sound risk management by banks and reduce the premium to be paid by the better rated banks. I will now announce 5 measures to improve the flow of credit to the real economy. 1. To expand the scope of capital market lending by banks, it is proposed to provide an enabling framework for Indian banks to finance acquisition by Indian corporates. Some of the acquisition finance related to infrastructure companies is already available, already provided. We propose to now expand it. 2. It is proposed to A. Remove the regulatory ceiling on lending against listed debt securities, and B. Enhance limits for lending by banks against shares from rupees 20 lakh to rupees 1 crore per person, and for IPO financing from rupees 10 lakh to 25 lakh rupees per person. These had not been revised for some time. 3. It is proposed to withdraw the framework that disincentivized lending by banks to specified borrowers, those borrowers which had credit limits from the banking system on the whole of rupees 10,000 crore and above. While the large exposure framework since put in place for the banks addresses credit concentration risk to a particular entity or group at an individual bank level, concentration risk at the banking system level, as and when considered necessary, will be managed through specific macroprudential tools. 4. To reduce the cost of infrastructure financing by NBFCs, it is proposed to reduce the risk weights applicable to lending by NBFCs to operational, high-quality infrastructure projects. This should give a boost to funding for infrastructure in the country. 5. Since 2004, about 20 years ago, licensing for UCBs, the urban cooperative banks, had been paused. No license has been given thereafter. Considering the positive developments in the sector, including legislative amendments in the Banking Regulation Act during the last 2 decades, and in response to the growing demand from the stakeholders, we propose to publish a discussion paper on licensing of new UCBs. I now come to measures related to ease of doing business, and we have been taking a number of measures over the recent few months and even earlier. I have 7 announcements to make, including those related to FEMA. First, a large number of circulars and directions totaling about 9,000 have been consolidated. I had earlier announced in this regard, and we have consolidated them subject-wise across 11 different types of regulated entities. Drafts of the same are ready, and they shall be issued shortly for public consultation. They should certainly aid simplification. Second, it is proposed to provide greater flexibility to banks for opening and maintaining transaction accounts of borrowers and OD accounts. This will particularly help borrowers which are regulated by a financial sector, for example, the NBFCs. Restrictions with regard to collection accounts are also proposed to be withdrawn. The export sector is a vital part of India's economy. To further strengthen the sector and enhance ease of doing business for them, we shall A. Extend the time period of Indian exporters in IFSC from 1 month to 3 months. B. Increase the period for forex outlay for merchanting trade transactions from 4 months to 6 months. And C. Simplify the process of reconciliation of outstanding entries related to exports and imports in the respective reporting portals, the EDPMD and the IDPMS. Sixth, and these relate to FEMA, again, key provisions relating to eligible borrowers, recognized lenders, limits on borrowing, cost of borrowing, end use and reporting, etc. in the ECB regulations issued under FEMA are proposed to be rationalized. Seventh, it is proposed to rationalize FEMA regulations regarding non-residents establishing their business presence in India. I shall now state 3 consumer-centric proposals. 1. The bouquet of services offered to BSBD account holders, savings, depositors, without a levy of minimum balance charges, is proposed to be expanded to inter alia include digital banking, that is, mobile and internet banking services. 2. The internal ombudsman mechanism is proposed to be strengthened to make grievance redressal by the regulated entities themselves more effective. 3. The RBI ombudsman scheme is also being revised for improved grievance redressal, and at the same time, we are also including the rural cooperative banks under the ambit of this scheme. Now, I have three proposals for internationalization of the Indian rupee. We have been making steady progress in this regard. The first proposal relates to permit AD banks to lend in Indian rupees to non-residents from three countries, Bhutan, Nepal, and Sri Lanka, for cross-border trade transactions. Second, to establish transparent reference rates for currencies of India's major trading partners, rupee-based transactions. And third, permit wider use of SRVA balances by making them eligible for investments in corporate bonds and commercial papers also. Let me now conclude. Despite an external environment that has deteriorated since the August policy, the Indian economy remains poised for high growth. The sobering of inflation has given greater leeway for monetary policy to support growth, while compromising on the primary mandate of price stability. However, the MPC decided to wait for the cumulative impact of the recent policy actions to play out before charting the next course of action as India strives towards achieving centenary year of its independence. It would need the coordinated support of fiscal, monetary, regulatory, and other public policies to attain its goal. The recent rationalization of GST rates by the government is a major step in this direction. In terms of actions, we will remain vigilant of the incoming data and stay focused on our objective of maintaining price stability while supporting growth. The various policy announcements today that we have mentioned will support the achievement of the goal of Viksit Bharat. And in pursuit of this objective, we will be and consistent in our communication while backing it up with credible actions. Thank you, Namaskar, and Jai Hind.